All right, welcome back to Power Lunch, everybody. Ahead of tomorrow's Fed meeting, it is time to check in with our own mock Fed. Our panel voted to keep rates steady this time, but just barely. Split verdict here. 4 votes in favor of cutting, 3 on the hold side. Have I got that right? Yes. Claudia Sam and Julia Coronado now joining Don Peebles in the cut camp. Excuse me, it's 4 holds and 3 cuts. We're joined now by one of the members of our panel who voted to keep rates unchanged this time around, Bill Lee of the Milken Institute. Bill, always good to see you. So if you were on the Fed today or tomorrow, you would be voting to hold rates where they are. Why do you say that?
I think we're making too big a deal out of the rise in the unemployment rate. After all, 4 to 4.5% is within the bounds of most people's estimate of where the natural rate is supposed to be. So for me, the risk of a slowdown is really coming from consumers. And what we're seeing is that more and more households are having to get second jobs in order to make ends meet. We see that because the survey in the employment numbers show that households are not growing employment very much, but payrolls are. That means more and more people need that second job to make ends meet. And there we see the risk of a slowdown. And for me, the consumers are still going to be confident that they're still going to be spending so long as we don't see layoffs. And right now, we don't see any layoffs accounting for the rise in the unemployment rate. So that really makes the case that we don't need to rush and accelerate any kind of rate cuts. And we need to make sure that inflation truly is on a downward trend. It takes 3 to 5 data points in order to make that trend convincing. And so that's it.
Go ahead, finish your thought. I'm sorry.
Well, the case is really not so much when to cut, but how much to cut. And I think the real discussion is going to be where will target neutral rate be? And I think it's going to be much higher than where most people think. And that means that given the rise in the federal debt and the competition for investment funds, we may see some crowding out down the line. But that is yet to be priced in by the markets. So for me, the key issue is hold now because the downside risks are not there, but the upside risks for inflation still remain.
So where are you on a cut at the next meeting, which comes in late September? Are you anticipating that you will go from the hold camp to the cut camp then? And what would it be that would, in that intervening period, what would it be that would change your mind? Or am I wrong and you're just saying, hey, let's just hold them here for as long as the eye can see, and when we start to see a difference in data, then I'll start to think about cutting?
Definitely not stay where we are. I think we're ready to move, but I think 2 more data points will be really make the case. We need to see the labor market continue to be where it is and not get much worse much more quickly. And we want to make sure that we don't see layoffs as the reason why unemployment rate is rising. The second thing I want to see would be a couple more data points on inflation and evidence that we are really on that downward trend. I think September is going to be if things continue the way they are now, September is a good time to start.
To start cutting. So you're just a holdout for now, Bill, but there's nothing that would keep you of a different mindset than what it sounds like the Fed is planning to do here with that September cut.
As I said, the key to the unemployment rate rise is whether it's accounted for by a rise in the labor force or layoffs. And right now, it's the labor force that's doing the increase, and that is a whole host of factors that have nothing to do with the need for weakened monetary policy.
I guess final question on this is: do you think that the Fed can message rate cuts with an economy that's still growing and inflation that, while disinflating, is still high and still has a lot of consumers, angsty?
I'm not a big believer in forward guidance because I think the credibility of the Fed has really been trashed over the years. But if there's a time to start putting in forward guidance, this is it. And the markets need some verification for whether the Fed will be ready to cut in September or to November or December. And that messaging has to be put in place at the next press conference. Otherwise, the uncertainty in the market is going to rattle everybody and make the recent volatility that we've seen nothing.
All right, Bill, thank you for now. We appreciate it. Bill Lee with the Milken.